In 2025, the global economy underwent profound adjustments amid tariff wars, with major economies showing divergent growth trajectories and accelerated supply chain restructuring. Nations navigated strategic competition to chart development paths. And in 2026, the global economy will seek equilibrium amid uncertainty, where open cooperation and risk prevention become critical. As the last rays of 2025's sunlight swept over Wall Street's charging bull statue, year-end settlement data for global financial markets quietly emerged. Behind the fluctuating curves of gains and losses, the ripple effects of the year-long tariff storm continue to unfold, slowing growth in some developed economies starkly contrasts with the counter-trend expansion of emerging markets, as the restructuring of trade patterns rewrites the global economic trajectory. How has this contest, dubbed by observers as the first major global economic test in the post-multilateral trade era, reshaped the world economic landscape? And where will the policy adjustments made by nations amid these turbulent waves steer the global economy in 2026? The answers lie within the verified economic data and policy implementations. The global economic stage in 2025 plunged into profound adjustment due to the new round of tariff policies initiated by the United States. On April 2nd, the U.S. government formally announced the imposition of so-called reciprocal tariffs on the vast majority of its trading partners, while threatening additional tariffs on products in key sectors such as automobiles, steel and aluminum, films, and semiconductors. This move shattered the multilateral trade cooperation framework that had persisted for decades since the post-war era, swiftly triggering a chain reaction across the globe. Unlike previous targeted pressure on specific nations, this tariff policy exhibits indiscriminate coverage. From heavy industrial products like steel and aluminum to consumer goods such as upholstered furniture and kitchen cabinets, the 25% tariff hammer struck nearly all global trading partners. On the day of the policy's announcement, the New York stock market experienced severe turbulence. The Dow Jones Industrial Average plunged over 2% in a single day, while the S&P 500 dropped 1.8%. Investor panic swiftly spread across global capital markets, dragging down the FTSE 100 in London and the Nikkei 225 in Tokyo. Emerging markets across Asia-Pacific experienced a collective plunge. To avert market collapse, the U.S. government urgently introduced a 90-day policy buffer period, effectively hitting the pause button on this hastily initiated trade confrontation. At its core, the tariff policy represents America's attempt to reshape the global distribution of benefits through trade measures. Policymakers initially hoped that imposing tariffs would reverse the trade deficit, expand fiscal revenue, encourage manufacturing reshoring, and safeguard industrial security. However, the actual results throughout the year fell far short of these expectations. Data reveals that while the U.S. trade deficit narrowed in 2025 compared to the previous year, the reduction was only 3.2%, falling far short of the policy's 10% target. Regarding fiscal revenue, the additional $300 billion generated by tariff hikes accounted for just 4.5% of total annual fiscal income, insufficient to offset the fiscal shortfall caused by tax cuts. Notably, the backlash effects of tariff policies have begun to manifest. Rising prices of imported goods directly fueled domestic inflationary pressures in the U.S. The average U.S. core PCE price index in 2025 increased by 2.7% compared to the previous year, with consumer goods prices accounting for over 60% of the increase. This led to a significant rise in the cost of living for middle and low-income groups. Faced with U.S. tariff pressure, countries worldwide have adopted countermeasures, forming differentiated strategies. As the world's largest trading entity, China's approach has consistently adhered to the principle of combining dialogue and consultation with appropriate countermeasures. After an unprecedented round of tariff adjustments, U.S.-China tariff levels peaked at 145% and 125% respectively. Since May, economic and trade teams from both nations have engaged in multiple rounds of negotiations and consultations. Following the Beijing summit on October 30th, where the two sides reached multiple significant agreements, both sides formally adjusted their tariff policies in November. The U.S. removed the 10% tariffs imposed on Chinese goods and extended the suspension of the 24% retaliatory tariffs on Chinese imports for another year, while China correspondingly adjusted its countermeasures. This development is widely regarded as one of the most stabilizing milestones in global trade for 2025. Bloomberg noted in its year-end commentary that China not only weathered the tariff shock but maintained its status as the world's most dynamic factory, completely overturning earlier predictions by some economists that China's manufacturing dominance would be weakened. Within the EU, however, significant differences in industrial structures have led to slow progress in negotiations with the U.S. Germany, as a major automotive exporter, faced the most direct impact from tariff policies. In the first half of 2025, German car exports to the U.S. dropped by 18% year-on-year. Consequently, the German government strongly advocated pragmatic negotiations to reduce trade friction, even expressing willingness to make concessions on automotive tariffs. France, however, focused more on agricultural trade and digital tax issues, firmly opposing excessive compromise on core interests and insisting the EU should maintain independence in trade policy. These internal divisions delayed substantive breakthroughs in EU-US negotiations until September 2025, when both sides tentatively agreed on a trade agreement framework. This framework established a 15% baseline tariff rate alongside hundreds of billions of dollars in investments in the U.S. and natural gas procurement arrangements. However, specific implementation details remain under discussion. Data indicates that EU exports to the U.S. declined by 12.5% year-on-year in the first half of 2025, with the sharpest drops occurring in key sectors like automobiles and machinery manufacturing. This dragged down Eurozone economic growth by 0.3 percentage points. Other major economies adopted distinct countermeasures. The UK took the lead in reaching an agreement with the US, becoming the first country to secure partial tariff reductions, though negotiations on critical sectors like steel remain ongoing. Japan and the US reached an agreement in July, with the US reducing tariffs on Japanese automobiles and parts from 27.5% to 15% and lowering reciprocal tariffs on Japanese goods to 15%. In exchange, Japan committed to $550 billion in U.S. investments and financing. Australia, through multiple rounds of consultations, secured a reduction in tariffs on mineral resources like aluminum and iron ore to around 10%, achieving its policy objectives in phases. India maintained a strong stance of autonomy, showing clear divergence with the U.S. on issues like reciprocal tariffs and market access. While making no substantive concessions, it also avoided further tariff escalation. Its firm position stems from the resilience provided by a relatively closed domestic market and steady economic growth. In this global tariff standoff, the World Trade Organization (WTO) has seen its regulatory functions severely weakened, 陷入 a state of dysfunction. Since 2019, the United States has refused to approve new WTO appellate body judges, leaving the body paralyzed and depriving trade disputes of an effective judicial resolution channel. In 2025, the WTO issued advisory opinions on multiple tariff disputes involving the US and Europe, as well as the US and Japan. However, lacking an enforcement mechanism, these rulings became largely symbolic statements. Data from the WTO headquarters in Geneva shows that in 2025, the number of global trade dispute cases accepted dropped by 40% year-on-year, while the backlog of unresolved cases increased by 25%. The authority of the multilateral trade coordination mechanism faced severe challenges. Economists at J.P. Morgan estimated in a report that the U.S. average tariff rate reached approximately 17% in 2025, with the global average tariff level rising by 2.1 percentage points year-on-year. Global trade entered a dynamic adjustment period fraught with uncertainty. The ongoing escalation of tariff conflicts has led to pronounced divergence in the economic performance of major global economies in 2025 as the initiator of tariff policies. The U.S. economy exhibits a dual trajectory in 2025, technology-driven. Growth coexists with accumulating debt risks. According to International Monetary Fund (IMF) data, the U.S. GDP growth rate in 2025 is projected at 2.0%, with an inflation rate of 2.7% and an unemployment rate of 4.2%. The real economy maintains a stable trajectory characterized by no standout highlights and no apparent risks, defined by Morgan Stanley as a soft landing phase. Despite intense tariff disputes and capital market volatility, the U.S. real economy avoided systemic risks, showing significant improvement compared to the risk accumulation of the previous 2 years. The AI industry emerged as the core engine of U.S. economic growth, with capital expenditures experiencing explosive growth. In 2025, the top 4 U.S. tech companies allocated over $300 billion in AI-related capital expenditures, equivalent to 150% of the nation's annual tariff revenue. Oracle issued $18 billion in 40-year bonds, setting a record for the largest single investment-grade bond issuance by a tech company, with all proceeds allocated to AI infrastructure development. The rise of the AI industry not only underpinned the stability of the U.S. stock market but also fueled household wealth growth. In 2025, U.S. household net worth increased by 5.8% year-on-year, with stock asset appreciation contributing over 70% of this growth. However, the trend of technological substitution for human labor has also caused polarization in the job market. In 2025, the U.S. tech sector laid off over 100,000 workers, while traditional manufacturing saw some growth due to tariff protection. It only added 35,000 new jobs, far from offsetting the tech sector's job losses. Employment pressures on middle and low-income groups continue to rise. Debt remains the greatest hidden concern for the U.S. economy, according to the latest data from the U.S. Treasury Department in November 2025. The total national debt, including intragovernmental accounts, reached $38.4 trillion, equivalent to 125% of annual GDP. The fiscal deficit for FY 2025 stood at $1.78 trillion, accounting for approximately 7.2% of GDP, while the government shutdown lasted a record 43 days. More alarmingly, interest payments on the national debt alone reached $1.2 trillion in 2025, equivalent to over $3,800 paid every second. Debt servicing has become the third largest category of U.S. fiscal expenditures, trailing only Social Security and defense spending. The passage of the Big and Beautiful Act further exacerbates debt pressures, projected to add $3 trillion in new debt. Both parties have tacitly agreed to a fiscal expansion debt financing Fed accommodation dynamic, a framework that will long constrain the U.S. economy's growth potential. Fluctuations in the dollar exchange rate reflect shifting market confidence in the U.S. economy. In the first half of 2025, the dollar experienced its worst opening in half a century, with the dollar index falling 6.1% from 103.5 at the start of the year to 97.2 by the end of June in the second half. As U.S. economic data stabilized and expectations for interest rate hikes intensified, the dollar index gradually recovered to 100.3 by year-end, though it still declined 3.1% for the full year. Notably, the negative correlation between U.S. Treasury yields and the dollar exchange rate broke down in 2025. The historical pattern where rising Treasury yields drove dollar appreciation no longer held, reflecting declining market confidence in the dollar's creditworthiness. In its year-end report, UBS Group projected that weak U.S. employment data or dovish policy from the Federal Reserve in 2026 could trigger another round of dollar selling. potentially pushing the dollar index below the 97 threshold once more. In contrast to the mixed outlook for the U.S. economy, China's economy demonstrated steady progress and structural optimization in 2025, according to preliminary GDP calculations released by the National Bureau of Statistics. China achieved an annual GDP growth rate of 5.0%, meeting its target and delivering an economic performance that was generally stable and better than expected. Amid shifting global trade dynamics and policy guidance, foreign trade emerged as a key driver of China's economic growth in 2025. Data shows that China's goods trade imports and exports maintained growth for 10 consecutive months, with exports rising 6.2% in the first 11 months. Exports to the EU and ASEAN grew by 8.5% and 12.3% year-on-year respectively, while the trade surplus surpassed the trillion-dollar mark for the first time. The continuous upgrading of export structure was particularly notable, with machinery, electrical products, and high-tech goods accounting for over 60% of exports. Significant progress was made in expanding into emerging markets such as ASEAN, the Middle East, and Latin America, injecting sustained momentum into foreign trade growth. High-frequency data also confirmed the vitality of China's economy. Big data from the National Information Center of the National Development and Reform Commission shows that China's consumer market maintained stable growth in December 2025, with offline consumption spending rising 0.9% year-on-year. Goods consumption and services consumption increased by 1.3% and 0.4% respectively. Consumer enthusiasm further surged during the New Year holiday period from January 1st to 3rd. 2026, consumption spending grew 6.1% year-on-year, with goods consumption and services consumption rising 9.3% and 1.1% respectively. In infrastructure investment, targeted measures introduced in the fourth quarter of 2025 such as new policy-based financial instruments and additional special bond quotas enabled steady project implementation. Nationwide project bid amounts rose 28% month-on-month in December, while the operating rates of petroleum asphalt plants and cement mills both turned positive year-on-year. Enterprise innovation vitality also maintained a positive trend. In December 2025, the Business Vitality Index for startups and the Business Vitality Index for technology innovative enterprises increased by 17.9% and 20.4% year-on-year, respectively. Despite the overall stable outlook, China's economy still faces dual challenges of insufficient domestic demand and structural adjustment. Although the consumer market showed signs of recovery, residents' propensity for precautionary savings remained strong. The household savings rate for the full year of 2025 stood at 34.5%. Down only 0.8 percentage points from the previous year, indicating that consumer willingness to purchase still needs further stimulation. Price data revealed that core inflation rebounded to over 1% by year-end. But the producer price index PPI remained persistently below -2%, suggesting that downward pressure on prices has not yet been fully alleviated. To address this situation, China has introduced a dual policy mix of market regulation and consumption stimulus, curbing vicious competition through measures against low-price dumping and improved pricing regulations to guard against deflation and debt risks, issuing 1.3 trillion yuan in ultra-long-term special treasury bonds, with 300 billion yuan allocated for old for new replacement and durable goods subsidies. Subsequent policy focus will gradually shift towards stimulating service consumption. The deep adjustment in the real estate sector stands as a defining feature of China's economic transition. In 2025, real estate investment declined by 15%, while sales dropped by 11.2%, dragging down GDP growth by 2 to 3 percentage points. However, with the implementation of a series of risk prevention policies, the market has broadly accepted the contraction in the real estate industry, and the risk of sudden defaults has been effectively contained in the short term. Concurrently, policy support is shifting from real estate to high-tech industries. Enterprises associated with new quality productive forces are accelerating their rise, with high-tech companies in industrial parks like Hangzhou and Shenzhen achieving over 20% year-on-year revenue growth. This shift seeks new engines for economic growth in the post-real estate era, driven by sustained policy efforts. China's economic sentiment index rose by 1.2 percentage points in Q4 2025 compared to Q3, indicating gradually strengthening endogenous growth momentum. Japan's economy faced the dilemma of high inflation and sluggish growth in 2025, according to estimates by relevant institutions. Japan's GDP growth rate for 2025 was approximately 0.8%, lower than the previous year's 1.1%. The consumer market showed weakness due to declining real wages. Domestic demand, accounting for nearly 60% of Japan's GDP, became the primary drag on economic growth. Persistent inflationary pressures are placing significant strain on ordinary citizens. In November 2025, Japan's core consumer price index (CPI), excluding fresh food, rose 3.0% year-on-year, marking the 51st consecutive month of year-on-year increases. Taking rice as an example, prices have risen continuously over the past 3 years, with nationwide supply shortages emerging in 2025. Despite nominal wages hitting record highs in recent years, growing to 0.8% in 2024, inflation has eroded real wages, which contracted by 0.3%. This decline in real household income has fueled persistently weak consumer spending. To counter this situation, Japan adopted a policy mix of fiscal expansion coupled with monetary tightening, yet found itself trapped in a policy offset dilemma. On December 16, 2025, the Japanese Diet passed a supplementary budget for FY 2025 totaling 18.3 trillion yen, the highest since the pandemic. The draft budget for FY 2026 is projected to exceed 120 trillion yen. Yet just before the fiscal stimulus took effect, the Bank of Japan announced on December 19 a 25 basis point hike in its policy rate to 0.75%, the highest level since 1995. This historic adjustment aimed to combat persistently high inflation and stabilize the weakening yen. Market reaction, however, was notably muted. On the day of the rate hike, the yen continued its decline against the dollar, with the trend persisting through the end of 2025. The year closed with the yen trading at 157 yuan to the dollar, marking an 8.2% depreciation for the year. Japan's deep-seated economic contradictions became more pronounced in 2025. The trade deficit persisted for the fourth consecutive year, reaching 5.2 trillion won in fiscal year 2024. Overseas profits were predominantly reinvested abroad, with minimal repatriation to the domestic market. The outlook for the services balance was concerning. Japan's digital trade deficit rapidly expanded due to its technological disadvantage in digital technologies, while its tourism surplus advantage also appeared unsustainable. The debt problem was particularly intractable. By the end of 2025, Japan's total government debt was projected to exceed 1,450 trillion yen, reaching 229% of GDP, far surpassing other developed nations. Interest payments on government bonds reached 7.9 trillion yen in FY 2024. Should long-term interest rates rise by another 0.5 percentage points, pressure on interest expenditures and fiscal space would intensify further. The Bank of Japan has acknowledged that merely reducing its holdings of exchange-traded funds (ETFs) could take a century, signaling a protracted and arduous path toward monetary policy normalization. The Eurozone economy will maintain its steady-state characteristics of low growth and stabilizing inflation in 2025. According to the European Commission's spring economic forecast released in May, the Eurozone economy is projected to grow by 0.9% in 2025, roughly on par with 2024's growth rate. Inflation will gradually decline to 2.1%, a 1.2 percentage point decrease from the previous year. However, compared to the fall 2024 projections, the European Commission has downgraded its growth forecasts for 2025 and 2026, reflecting the dampening effects of tariff shocks and geopolitical uncertainties on economic expansion. Eurostat data shows that seasonally adjusted Eurozone GDP grew by 0.6% quarter-on-quarter in Q1 2025, slightly higher than the 0.3% recorded in Q4 2024. Year-on-year growth reached 1.5%, marginally above the 1.2% recorded in Q4 2024, indicating a modest recovery momentum. As the Eurozone's largest economy, Germany's performance directly influences the bloc's overall trajectory. Germany's economy has remained sluggish over the past 2 years, with U.S. tariff policies further impacting key manufacturing sectors like automobiles. In the first half of 2025, German auto exports to the U.S. fell 18% year-on-year, dragging down GDP growth by 0.4 percentage points. To reverse this economic downturn, Germany formally enacted its debt brake reform bill in March 2025. This legislation exempts defense spending exceeding 1% of GDP from the debt brake restrictions while approving amendments to the Basic Law. It establishes a €500 billion special fund for infrastructure development, marking the end of Germany's cautious fiscal policy. According to International Monetary Fund (IMF) projections, Germany's fiscal deficit to GDP ratio will reach 2.95% in 2025, with public debt to GDP at 65% already, exceeding the EU's 60% threshold and projected to rise to 74.85% by 2030. Economic performance within the Eurozone shows significant divergence. Spain benefits from tourism recovery, achieving 2.3% GDP growth in 2025 to become the fastest-growing major economy in the Eurozone. France and Italy experience moderate growth at 1.1% and 0.8% respectively. Beyond Germany, Austria also faces energy transition pressures and trade shocks, resulting in a growth rate of just 0.5%, making it one of the slowest-growing developed economies. Jiao Yaoting, Investo's Asia-Pacific global market strategist, noted that increased defense spending by European nations in the coming years could stimulate corporate capital expenditures, boost construction activity, and subsequently drive job creation and wage growth, thereby providing some stimulus to the European economy. However, Cheng Shi, chief economist at ICBC International, cautioned that while fiscal policy expansion in the Eurozone in 2025 would inject marginal positive effects into the economy, its impact would be constrained by the structural low-growth trap and deteriorating external conditions. Faced with multiple constraints including pressure on exports to the U.S. and sluggish domestic demand, the Eurozone's recovery foundation remains fragile. On the global economic map of 2025, besides divergent growth among major developed economies, emerging and developing economies also exhibit significant performance disparities, becoming key variables in global growth. The International Monetary Fund's October World Economic Outlook report indicates that emerging and developing economies will grow at 4.2% in 2025, becoming the primary engine of global growth. Among them, Asian emerging economies are particularly impressive. ASEAN countries maintained a 4.7% growth rate, while South-South trade grew by 8% in the first half of the year, exceeding the global average. This divergence reflects the restructuring of the global economic landscape. Traditional developed economies are experiencing sluggish growth, while Asia, Latin America, and Africa are gradually reshaping the trade map through supply chain diversification and digital transformation. India stands out as the growth star among major global economies in 2025, leading with a 6.6% growth rate. India's economic growth is driven by three key factors: its demographic dividend, the benefits of the China Plus One strategy, and access to low-cost energy imports. infrastructure projects are visible across cities like New Delhi and Mumbai, with India's infrastructure investment growing by 12.5% year-on-year in 2025, fueling rapid development in sectors like steel and cement. The consumer market remains robust, with total retail sales of consumer goods increasing by 8.3% year-on-year, as the expanding middle class drives consumption upgrades. However, India's economy also faces challenges such as weak infrastructure and high unemployment. In 2025, the youth unemployment rate remained as high as 23.5%, limiting the sustainability of economic growth. Ireland ranked among the world's fastest-growing economies with an IMF estimated growth rate of 9.1% and an OECD estimated rate of 10.2%. Yet, this impressive figure was underpinned by specific factors. The primary drivers of Ireland's rapid economic growth are profit shifting by multinational corporations and the advanced export of pharmaceuticals. Its 3.3% GNI growth rate more accurately reflects the true state of its domestic economy. This phenomenon also highlights the unique position of some small open economies within the global economic landscape, where economic growth is highly susceptible to multinational capital flows and international market fluctuations, resulting in relatively weaker stability. In stark contrast, some nations face developmental crises due to political turmoil, conflict, or structural economic flaws. Haiti and Myanmar, mired in political instability and warfare, saw their GDP plummet by 12.3% and 8.5% respectively in 2025, exacerbating food shortages and humanitarian crises. Venezuela, Zimbabwe, Iran, Argentina, and Turkey grappled with hyperinflation, with Venezuela's inflation exceeding 1,000% and Zimbabwe's reaching 850%. Structural economic flaws and the pressure of international sanctions weighed heavily on these nations like two mountains, leaving them struggling to breathe and causing a significant decline in the living standards of their citizens. The restructuring of global trade patterns in 2025 also exhibits several new characteristics. Beyond the direct impacts triggered by tariff policies, the trend toward supply chain diversification has accelerated further, with enterprises in multiple countries beginning to adjust their supply chain layouts to reduce reliance on any single market. Data indicates that investments related to global supply chain restructuring grew by 15.8% year-on-year in 2025. Southeast Asia and Latin America emerged as primary destinations for supply chain relocation, with manufacturing investments in Vietnam, Malaysia, and Mexico all exceeding 20% year-on-year growth. China maintained its core position in supply chain restructuring by leveraging its comprehensive industrial system and efficient industrial chains. In 2025, China's manufacturing value-added still accounted for 28.3% of the global total, a slight decrease of 0.2 percentage points from the previous year, demonstrating strong industrial resilience. Regional economic and trade cooperation has emerged as a vital force in countering global trade protectionism, driven by the China-ASEAN Free Trade Area 3.0. Industrial chain and supply chain collaboration between China and the ASEAN region has grown increasingly robust. By 2025, China-ASEAN trade volume increased by 12.3% year-on-year, with ASEAN maintaining its position as China's largest trading partner. Economic and trade cooperation within the European Union also deepened further. In 2025, intra-Eurozone trade accounted for 65.2% of total trade, an increase of 1.5 percentage points from the previous year, demonstrating the buffering effect of intra-regional trade against external shocks. Additionally, the implementation of the Regional Comprehensive Economic Partnership (RCEP) continued to yield results. In 2025, trade among RCEP member countries grew by 9.8% year-on-year, becoming a key engine for global trade growth. Looking ahead to 2026, the global economy will seek a new equilibrium amid uncertainty. The United Nations January 8 report World Economic Situation and Prospects 2026 forecasts global economic growth of 2.7% for 2026, slightly below the 2.8% projected for 2025. The report notes that despite substantial U.S. tariff hikes in 2025, the global economy demonstrated unexpected resilience, sustaining growth momentum supported by robust consumer spending and moderating inflation. However, deep-seated vulnerabilities persist. Sluggish investment and constrained fiscal space are dampening economic activity and heightening risks of prolonged low-growth trajectories. The initial easing of trade tensions helped mitigate the impact on international trade, but the combined effects of higher tariff levels and rising macroeconomic uncertainty are expected to become more pronounced in 2026. The UN report projects global trade growth to slow to 2.2% in 2026, down from 3.8% in 2025. Growth prospects also vary across major economies. The U.S. economy is projected to grow around 2.0% in 2026, as weakening labor markets dampen momentum. EU growth is expected to slow to 1.3% in 2026, pressured by U.S. tariff hikes and persistent geopolitical uncertainties affecting exports. Japan's growth is forecast at approximately 0.9% in 2026, impacted by a persistently weak external environment. East Asia is projected to grow by 4.4%, South Asia by 5.6%, Africa by 4.0%, and Latin America and the Caribbean by 2.3%. Emerging and developing economies will remain the primary drivers of global growth. Core risks to the global economy in 2026 center on four key areas. First, the lagged effects of tariff policies may trigger a rebound in U.S. inflation. While the U.S. core PCE price index is now approaching the Fed's 2% target, the full impact of rising import prices has yet to materialize. Should consumer demand recover in 2026, it could push inflation higher again, constraining the Fed's room for monetary policy adjustment. Second, risks of an AI industry investment bubble. The explosive growth in US AI industry investment in 2025 has already exhibited signs of irrationality. Should AI technology commercialization progress fall short of expectations in 2026, it could trigger a capital market correction and drag down tech sector growth. Third, debt risks in major economies. Debt levels in the US, Japan, and the Eurozone are at historic highs. Should global interest rates rise in 2026, it would significantly increase debt repayment pressures and potentially trigger localized debt crises. Fourth, uncertainties in Sino-US economic cooperation persist. Although both sides reached a phased consensus on tariff policies in 2025, competition in technology and industrial sectors will continue. U.S. authorities are expected to rule on the legality of the U.S. government's so-called reciprocal tariffs, with the outcome becoming one of the greatest unknowns, affecting global trade in 2026. Faced with complex global economic conditions, policy choices by nations will be critical. Major economies including the U.S., China, Japan, and Germany plan to increase fiscal spending in 2026, driving growth through debt expansion while focusing investments on strategic sectors like AI, semiconductors, and new energy to cultivate new growth drivers. China has announced the first batch of key projects under this development initiative and the central government's investment plan for 2026. It has also recently approved or authorized multiple major infrastructure projects with a combined investment exceeding 400 billion yuan, providing stable support for economic growth. The European Union plans to stimulate corporate investment and job growth through sustained capital expenditures under the Next Generation EU Fund, while advancing energy transition and digital upgrades to enhance the sustainability of economic growth. From a global governance perspective, repairing the multilateral trading system still faces numerous challenges, but deepening regional economic and trade cooperation and reforming global economic governance mechanisms have become irreversible trends. Discussions on WTO reform achieved some progress in 2025, with preliminary consensus reached among some member states on the appellate body reform proposal. If reforms can be implemented in 2026, it will help restore the functionality of the multilateral trading system. Furthermore, international cooperation in areas such as global climate governance and digital economy rulemaking is gradually advancing, injecting new positive energy into global economic growth. Looking back at 2025, the global economy underwent profound adjustments amid tariff storms, with nations exploring development paths through both competition and collaboration. The divergence and restructuring of economic landscapes became the defining features of the year. Entering 2026, the global economy will enter a new phase of seeking stability amid divergence and pursuing growth through adjustment. The ability of countries to balance fiscal expansion with risk prevention will determine future economic trajectories. In the economic contest without gunpowder, only by upholding openness and cooperation, promoting mutual benefit and win-win outcomes, accurately positioning oneself, and mastering the pace of development can nations steadily navigate the turbulence and jointly propel the global economy toward more inclusive and sustainable growth.